Let's have a look at these past picks now from David Burrows. He's the president of Barometer Capital Management. We're looking at June 28th of last year. You recommended Starbucks around $39. It's up 35%. Now you're out of it. Did you hit a price target here, or what can you tell us?
Yeah, you know, it was a great trade. It worked out very well. It hit a high of just over $60 a share. We came out of it getting stopped out back in May as the market started getting a little more difficult. So some of the consumer discretionary stocks started to back off. Around the same time, McDonald's started to back off, and Yum Brands. And so, you know, it's just a group we've stepped away from in the short run. I think it's a great long-term hold, and there probably will be a re-entry point sometime later in the year. They're executing well and have great growth in the business.
Magna, you recommended at $51.41. It's down 20% since then. When did you get out and why?
That was that one didn't work out well for us. We came out of that one in August of last year, so probably only a month or two after we talked about it. The auto group started to back off, and we got taken out of our position. If you remember, August and September of last year were horrible months for the market, and our strategy is when things get sloppy, swim for the sidelines, and you know, we lost a little bit. We didn't lose very much. It could have been a lot worse.
Precision Cast Parts was recommended at about $160 or so. It's up a couple of percent. Again, you're out of this one. When and why?
So this was a whole play on the reinvestment by airlines in more energy-efficient planes and the Boeing upgrade cycle. You know, it was a profitable trade. Again, more economically sensitive stocks are, you know, under some pressure at this point. So we really, through February and March, carved out a lot of the economically sensitive stocks from our portfolios. We moved more towards staple and pharmas and so on. And so we came out of it, I think, around $170 a share, something like that.
And just, don't have too much time here, but explain the discipline of getting out of a stock, how you do it, what you look for.
So our view is we want to be invested in markets where, over time, you're seeing expanding breadth, where more and more stocks are participating in a rally. That's a healthy market. That's money getting put to work. So we look at the asset class level to say, is that the case? Then we look sector to sector. We look at 41 industry groups. We want to own sectors that are seeing expanding breadth again, where you're seeing more and more stocks participate in a rally. And so long as that's the case, now we want to find companies that have better than the group fundamental characteristics. And that comes down to earnings growth and cash flow, balance sheets, and so on. So we want to look for companies that could see an expanded earnings multiple over time. So asset class, sector, security specific. And then we run stop losses on all of our positions because we all make mistakes and we can't afford to make big ones. And so we run stop losses up that ratchet behind, and if we get stopped out, we get stopped out.
All right, interesting. David Burrows, we'll have more with him right after this. Half an hour to go. We'll get back to calls and emails after this.